Welcome to the Real Estate Espresso podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Minash. When investors look at silver performance over the last 2 years, it's tempting to focus on headline numbers. Silver is up significantly. In percentage terms, it's outperformed gold, platinum, copper, equities, and bonds over much of that period. That fact alone has drawn attention. It's up 180% over the past 24 months. But as with any asset, the more important question is not what went up, but why and whether those forces are sustainable. Silver's recent performance is not an isolated story. It sits at the intersection of monetary policy, industrial demand, because it is also an industrial metal, and investor psychology. Understanding that intersection matters far more than celebrating things after the fact. Silver is unusual among widely traded metals because it serves two very different purposes. On the one hand, silver behaves like a precious metal. It's viewed as a monetary asset, a hedge against currency debasement, and as a store of value during periods of uncertainty. On the other hand, silver is an industrial metal. It's used extensively in electronics and solar panels, in medical devices, and a growing number of electrification technologies. That dual role explains much of its recent performance. Over the last 2 years, investors have been forced to reconcile persistent inflation, expanding government debt, and rising geopolitical risk. These conditions tend to support hard assets broadly. We saw it first in gold. At the same time, global investment in electrification and renewable energy has accelerated, despite some of the things that are happening in the U.S. that have maybe pumped the brakes on that aspect. That means physical demand for silver is a little bit different from gold. Silver is not just being sought as protection, it's being consumed. Gold remains the anchor of the precious metal complex. Its market is deeper, it's more liquid, and it's far more institutional than silver. Its value is more concentrated, so central banks tend to buy gold. Sovereign wealth funds tend to hold gold. And when fear dominates the market, gold is typically the first destination. Its value per ounce makes gold more efficient as an investment vehicle than silver. But over the past 2 years, even though gold has performed well by any historical standard, it has reached new nominal highs and it's delivered strong returns relative to bonds and even cash. Silver has outperformed gold on a percentage basis. That shouldn't be surprising. The smaller market means capital flows have a greater price impact, and when sentiment shifts in favor of the metals, silver tends to move faster and further, but it usually happens after the movement in gold. So this cuts also both ways. Silver's volatility is also higher than that for gold. Investors who treat silver as a calmer version of gold don't understand the risk profile. Gold preserves purchasing power. Silver magnifies those themes. If we look at Platinum's performance of the same period reflects a narrower set of drivers. Platinum is also an industrial metal. It's used in the automotive catalytic converters, as well as in emerging hydrogen technologies. Supply is geographically constrained, which can create much bigger price volatility when disruptions occur. Over the last 2 years, platinum has benefited from supply tightness and very specific industrial demand. In certain windows, its returns have rivaled gold, but platinum lacks silver's breadth of use and gold's monetary role. From a portfolio standpoint, platinum is not a substitute for either gold or silver. It's more concentrated and it has more cyclical exposure. Copper tells a different story altogether. Unlike silver and gold, copper is not held for protection. It's also an industrial metal. It's used in copper wiring all over the world. Its price reflects expectations about construction, infrastructure, manufacturing, and of course, its use in electrical systems. Over the past couple of years, copper prices have risen, but it's not to the same degree as silver. The drivers are pretty straightforward. Energy transition requires copper. Expansion of the grid actually doesn't require that much copper. It actually requires much more aluminum than copper because most of the high voltage transmission lines are aluminum, not copper. Electric vehicles require a ton of copper. Copper's performance is reinforced in a broader theme. Copper is not a reflection of monetary risk, it's a reflection of economic activity, specifically in construction. When compared with traditional investment classes, metals have stood out. Equities have delivered respectable returns, largely driven by expansion and concentration by a small number of large companies. Bonds have struggled, and we all know the reasons for that. It has everything to do with interest rates rising, which has negatively impacted bond values. Real estate, depending on the segment, has faced pressure from higher interest rates. And against that backdrop, metals have offered something rare. Returns not directly dependent on leverage. It's not dependent on credit expansion or any financial engineering. It doesn't make metals a superior asset, it makes them different. So while I'm a big proponent of the metals, that doesn't mean there's no risk. Silver remains volatile. Its industrial demand is sensitive to economic slowdowns. The investor base is small, and it's more sentiment-driven than gold. Price correction can happen quickly. Silver should not be viewed as a replacement for disciplined investing in productive assets. It doesn't generate cash flow, and it doesn't compound internally, but it does benefit as a hedge against inflation. The past couple of years have reinforced a simple lesson. Assets tied to physical resources have been rediscovered and they've regained relevance. Silver sits in that category, like any real asset. It benefits from both monetary concerns and industrial necessity. Gold remains the great stabilizer. We know that many countries are buying significant percentages of the world's gold production, and then copper reflects economic build-out, with pretty constrained supply, by the way. The mistake many investors make with the metals is chasing performance instead of understanding function. Silver's recent outperformance is informative, but it's not predictive. Its role in the portfolio should be intentional, it should be sized appropriately, and understood for what it is. It's a volatile hedge with industrial tailwinds, not a substitute for long-term value creation. These cycles will come and go, and your investment discipline will outlast all of them. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.